Hey, welcome back everyone. It is time for another red hot covered call video. Today we're going to finish up on the deep in the money covered call. See, I just did one and I want to put this all in a nice and tidy package for you, straight talk style. I'm going to show you an example. We're going to talk about why I did it and how I became profitable in the trade. Deep in the money covered calls might become a big thing. Why? Because if this stock market, which is raging higher, if it starts to fall, we have to have tools in our toolkit. And those tools in a falling market, selling premium, are going to be selling deep in the money covered calls and selling cash secured puts. So although I think the market keeps going higher or sideways and we can keep writing those out of the money strikes, you have to have your tools in your toolkit, right? You have to, because if you don't, you're going to get caught off guard. You're not going to be prepared. You won't have a plan, and you'll be like me when oil crashed. I sat on my hands and watched me lose day after day. We don't do that anymore. We have to have our tools. That's why I'm doing this video series. Before we get going, and we are going now, subscribe to the channel. It's right there in the corner. And hey, look, while you're here, bang that like button, guys. It lets me know you like what I'm doing. Now we're going to talk about the deep in the money covered call. We're going to talk about a trade I did, and we're going to explain it so you understand it. We're going to put this in a nice, neat package for you. So 2 videos ago, I showed you the covered call advisor. I've talked about the covered call advisor before. He is a great resource. This cat posts all his stuff online, and I love it because he breaks it down. You know, I talked to one of my good friends who loves the covered call advisor. He loves how he breaks it down. Really breaks it down to profitability. So I check the covered call advisor every once in a while just to see what he's doing. I mean, look, the covered call advisor keeps knocking it down. You talk about success. Well, one thing that we noticed with the covered call advisor recently is he's writing a lot of deep in the money calls, and he's pocketing that 2%. Now, that is the sweet spot of covered call writing. We want to have those nice and tidy 28 to 35 day trades. We pocket that 2 and 3%. We do it conservatively, and that's what he does. So I'm checking out the covered call advisor. He wrote a Bristol Myers covered call, and I did too. I did a video on that. He wrote the deep in the money strike where I wrote the out of the money strike. And I showed you how both trades worked out. Well, I followed up on the covered call advisor, and sure enough, he did another deep in the money call on Alibaba. Well, I like this trade, and I'm thinking to myself, look, I know the risks of owning Alibaba. I know that I'm going to buy the shares. I know I'm going to own the shares. So I'm looking at this trade, and I like the trade. Now, I'm not going to follow the covered call advisor. That's not what I'm going to do. I have my own game. But I like this trade, and I'm going to watch it. Well, I decided I'm going to do it. So the covered call advisor, basically, at 180, he said, look, Alibaba had fallen, and he felt that it was really just profit taking. So he stuck it in for 180. It's right there. He then wrote the deep in the money 170 because he has this modest to neutral take on the market. So he wrote that deep in the money covered call. He got paid $13 plus. Basically, he gets 2% on this trade. Now, this was a 32-day trade. He breaks it down. So I decided, look, Alibaba's in this great spot. I agree with him. So I'm going to do it as well. So that's what I did. I went out, I bought Alibaba at 185. I sold the deep in the money 175, and I got paid basically the same, over $13. And that's what we're going to talk about. By the way, same expiration date. We're going to talk about that and how this trade can play out, okay? So let's go over here to Alibaba. Let's look at the chart first because the chart's going to tell us a story. So Alibaba has just absolutely been rallying higher. And if you don't know who Alibaba is, quite frankly, it's the Amazon of China. I've been watching Alibaba ever since they went public, and it has just been a steady climb, and recently has been rocketing higher. Now, it's moving with the rest of the market, but Alibaba has recently peeled off. And this fall right here, okay, that was when the NASDAQ fell, all the tech stocks fell, but the Dow was rocketing 300 points higher. It's one of those moments in time where if you're looking to play those NASDAQ stocks, that was a great time to buy. I talked about how I bought NVIDIA on that day. And sure enough, they're all right back to all-time highs. So Alibaba has recently sold off as well, and you could see that it's fallen off pretty good there. No news whatsoever. So I, like the covered call advisor, definitely think that Alibaba is going to drift higher with the market. So I don't feel like sticking in a deep in the money covered call here for 28 days. 28 days, I don't think that's much risk here for me. So what did I do? At 184X, I bought 200 shares. I wrote the 175x 13 plus dollars. So it gives me that 2% 28-day gain. It's a deep in the money covered call. So what does that mean? Let's break this down. I bought Alibaba again. Let's keep the numbers straight. I'll say 185. I sold the 175 deep in the money covered call. So you could see right now, if Alibaba just trades sideways after 28 days, I am clearly going to have my shares taken away because it's trading at 185. The cat that bought my option is going to get the shares at 175. Well, see, I got paid $13 for this, okay? So let's do the math on this. You could see right off the bat, there's $10 of real money in it, right? The stock's trading at 185. I'm going to give my shares away at 175. I got paid $13 to do that. And this is 28 days, okay? The $10 scratches out, and I'm left with a $3 premium. Remember, we have real money plus time value. That's what an option's made up of. So when you see an option price, you have real money and time value. Now, if you write the out of the money strike, well, there's no real money. So all you're looking at is time value. And if you write it deep in the money strike, you're going to have real money plus time value. And in this case, I have $3 of time value. So I get a little bit of premium. And by the way, that $3 is my profit. I make nothing above 175. I'm giving this cat the right to take my Alibaba shares away from me at 175. Now, I get that $3 premium in my pocket. Now, for me, that's 2%. That's 28 days. We're going to take that every day of the week. Let's talk about this trade and what happens 28 days from now. So let's sum this up. Remember, I bought the shares at 185. I'm going to give somebody the right but not the obligation to buy my shares at 175, and they paid me $13. Remember, $10 of this is real money. $3 of this is time value. That $3 is my profit. So it's 28 days later. Let's break out the scenario. Let's say that Alibaba has traded sideways. This guy is going to take my shares from me at 175. I'm going to give up my shares at 175. So I get 175 plus the $13. I profit $3 from this trade. That's 2% in 28 days. Let's say Alibaba goes to 195. Well, good for him. See, I make no more than 175. So this guy is going to take my shares away from me 28 days from now. I get 175 plus my $13. I profit $3. Remember, I bought at 185. Let's say Alibaba falls to 180. Now, this guy who bought my option paid me $13. He needs Alibaba to be at 188 and above to be profitable. Well, here's how this could play out for him, whoever that person is. Even if Alibaba falls to 180, they will take my shares. Why? Because the option on expiration will have no time value, but it'll have real money in it. So this option that I got paid $13 will be on expiration at least $5. And it'll probably be $5.01. So what will he do? He'll probably take my shares, getting 180 for the shares, selling the shares, and recouping $5 of his $13 loss. See, he's lost money in this trade, but he still has value in the option. So even though he becomes profitable at 188 and above, he might take the shares at 180, sell the shares immediately, and basically he crosses out the $13 premium he paid with the $5 gain in the stock, so he doesn't lose as much. I know that sounds odd, but that's what people do. Now, let's say he doesn't do that. Well, the market maker will take my shares. Why? Because it's above 175, my strike price. See, the market maker has no cost. So anything above 175, because the market maker has no cost, they can come in, take my shares from me at 175, sell the shares immediately wherever it's at, and they're going to profit. So my shares are going to be taken away. By the way, that's a bigger theme that we talked about before. Anytime the stock is above your strike price, whether this cat makes money or not, the market maker will take your shares, even if it's 1 penny. Now, that's how this trade basically is going to play out. Oh, last thing, if Alibaba trades under 175, this is how this plays out. Nobody will take my shares because it's not profitable. I keep my shares and I keep that premium. here is the deep in the money covered call downside protection we talk about. See, I have $13 of downside protection. So as Alibaba is falling to 175, here's the deal. Say it falls to 174 and it's Friday. I keep my shares, I keep my premium. Well, let's do the math. I have Alibaba at 174. I was given $13 in real premium. So look at this, guys. I have an Alibaba stock that is at 187, even though the stock is currently at 174. That's the downside protection. And I'm going to do a video on downside protection to really break that out. But do you see how that works? See how that works? As the stock is falling, I own that $13 premium. That's going to make up the difference. It's going to make up the difference as the stock falls. So as the stock falls $1, I have the $1 premium in my hand. It falls $2, I have that $2 premium in my hand. I have $13 of downside protection. Do I want Alibaba to fall? No. What I'd love to do is have this trade play out just like this, stay above 175, have my shares taken away. I collect the 2%. We collect our money. We do it again. Man, I'll tell you what, this was a great exercise in learning the deep in the money covered call. And I really want you guys to understand, that when you look at that deep in the money covered call option price, you have to look at what is real money and what's time value. And it's that time value that is your profit. And you take that time value, $3, you divide it by your purchase price of the stock, and that gives you your percentage gain. So that's how we're going to break this out. I want you to learn this. Look, if I went too quick, watch it again. And if you like this deep in the money covered call discussion, I have those videos. Remember, I have the videos out here. I just did one here. I just did one here. And remember, in that video, I tell you to search in the money, and you'll see even a better deep in the money covered call video. Hey, look, before I get going, what I do want you to do is go download my free spreadsheets. Look, we have to keep the numbers in front of us, and that's the only way. It's the only way we do it. Now, hey, before I let you go, look what I have. You saw that. Ask John. I want you, ask me your cover call questions. I want you to make suggestions for future videos. See, I don't want to become stale and boring. See, talking about the same thing. I want your ideas. I want you to go there. I want you to give me a suggestion. Hey, look, till next time, I hope all your covered calls are profitable.
All I see is signs. All I see is dollar signs. Oh, money on my mind. Money on my mind.